Crystal, how are you?
I am good. Yourself?
I am great. Thanks for joining me again. I got the sign that said you are live, so that means we must be live. That's very cool.
Somewhere out there, we're live.
You're live somewhere. So, got an exciting thing to talk about. Hopefully, you got the message that I sent in the message about what we're supposed to talk about.
Yes, we're going to talk
Okay,
about
cool.
avoiding bank closures, right?
Okay. And I'm going to try to use my little screen here to do to show the both of these answers to the question how did Mr. Buffett avoid the bank crisis, and a little technology play there. It doesn't seem to be working, but we're going to give it a shot. But
Okay.
first, I'd like to read your bio,
Okay.
um, and um, and then we'll go from there if that's cool.
Sounds good to me.
Okay, here we go. Okay, so welcome everyone to my friend and colleague, Crystal Mitchell. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions. She's the co director of Recycling Black Dollars, a co host of The Business Zone with Crystal and Gilbert, that other online radio show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Hey, Crystal, how are you?
I am fine. And yourself?
Crystal, if I was doing any better, I'd be as pretty as you.
Ah, that's nice.
Okay.
So we are into the second week of May, being my favorite month of the year.
Is that because it's your birthday month?
It is. It's my, as I'm saying on all of my shows, it's my birth
Nice.
month.
Birth
But
month.
month because since I bring in the month, since the first
Hello.
day is my birthday, I get
There
to
you
celebrate
go.
a whole entire month.
That's awesome. Did we forget May Day? Was there a May Day in
Yeah,
there?
May Day is my birthday. May
That's
Day.
your birthday. Oh my God. Talk about celebrating. Well, good thing you're claiming the whole month. And thank you for bringing it in so lovely for us. It was a good day. Appreciate that.
Yeah, so I
We'll
spent
give that one to you.
that's what I spent my weekend doing, some celebrating. And
There
so
you go.
every day there's a little bit of celebration. So went to a
Oh,
play and
man.
I
You
had
got lots of stuff. We got Crystal's birthday, Cinco de Mayo, May Day.
Mhm.
Man,
I
that's a
know.
lot.
And then the other half of my family, well, my family's birthdays are like we're split. May
Uh-huh.
and June. That
In
pretty
June.
much we dominate May and June. I don't know what was 9 months before May and June.
Okay. That
But
would
most
be
of my
like the
family
fourth,
that was in the
fifth.
in the north, I know what was
Okay.
happening in Buffalo.
Hello. There you go. There you go. Yeah, that's right around August and what is that? August and
That's August, the beginning part of winter for us. When we were doing some
yeah,
canning and stuff,
that
getting ready for the
yeah,
winter,
fall things and stuff.
fall
Yeah.
thing going on. And in Buffalo, fall can start it in August. But but yeah, so that's that my family every day I've been wishing everybody in my family a happy birthday. All the
There
way
you
it
go.
goes all the way up until the 17th
Nice.
of
Of
19th
June.
of May. Everybody in the family is
Okay.
on one of those days.
Okay. That's cool. That's cool.
Hmm.
I like that. I like that. You got to have a reason.
Yeah, you gotta have a reason.
You
But
got
other than that, it's so far so good. Little rest in that, some
Oh,
rest,
excuse me.
which I definitely need. So
Oh, excuse me.
bless you.
Thank you. Okay,
And
well
let's
let's
get
get started
started.
here. So I'm going to
Hmm.
try this little technology thing here. It was working really well um, at 12:30.
Okay.
It's decided
All
to
righty.
change. So here we go. So bear with me.
Uh huh.
So the reason I'm going to pull this up is when you talk to a financial advisor, there's an old story about talking with a financial advisor. It says if you put 12 financial advisors in the room and give them the same software, the same situation, you should get 13 different answers as to how to, to arrange the portfolio.
Okay.
13, not even just
13,
12. You should get 13.
13.
And
Okay. An odd number, no less.
indeed. And that's how this thing goes. So I'm going to try and show you two answers to the same question, and then we're going to talk about that.
Okay.
I think I got it.
That's
Okay, can you see those two paragraphs?
I can.
Okay, so the question was, how did Mr. Buffett avoid the current banking crisis?
Mm,
So the first answer, this was embedded in an article that I read
okay.
over the weekend.
Okay.
So the first answer is, the title does not match the facts. Warren Buffett was unable to avoid the current banking crisis. Bank of America, his second largest holding, and that bank crashed and still hasn't recovered. In fact, Warren Buffett in the last 5 years earned almost nothing from his holding except insignificant dividends. 5 years of his investment in this bank was a waste of time. Wow, that's pretty harsh, isn't it?
Yes, that is.
Okay, so and then another person, and these are not financial advisors, these are just people, quote unquote, in the know.
Okay, in the know.
The second answer was, he has a high-powered team of analysts that went through each bank and looked at how it operated. He dumped ones he didn't like first, like Wells Fargo, which I keep expecting to collapse next. It's not possible for any ordinary investor to do that, but if you have a big team, it's a great strategy. Knowledge is power. So there's a whole bunch of stuff in there that we don't need to get into, but if you think about it, one person is saying he did avoid it, and the first person is saying he didn't. And then they give some supporting evidence for that. So then we got to think, well, what am I supposed to do? I'm just little me, and I've got children to feed, and I got to work every day, and my job is not watching the market. I got to do other stuff to put food on the table. So what am I supposed to do? So let me stop sharing this, and we will get back to you. Yay, there you are. Okay, so what do you think? What are we supposed to do?
I think, well, Warren Buffett is like my guru, right? But I do know that okay. I just love, because I think I think he does a lot of thinking before he makes investments. And I think in my opinion, from what I've read and about him, he
Sure.
doesn't willy-nilly invest. He doesn't emotionally invest. He doesn't invest from the heart. He invests from the head. That's kind of how my interpretation of how he invests his money. He thinks it through, and it has to make sense to him. It has to make really good sense to him. So, and he thinks like an accountant, because numbers don't lie, right?
Okay.
And so I think and his team makes wise decisions based upon research. So that second one seems to me to have made sense, that he would, before he would put his money somewhere, he would make sure he does a thorough research to make sure that with whatever certainty you would have with someone managing your money outside of yourself, they would be capable of doing it.
Okay. Cool beans. Well, I can only say that sounds reasonable to me.
Okay.
Reasonable as usual. I would say that so many times when we do and when have these discussions, I don't know if I've told you this before, so maybe not that many times, but I think we focus on the wrong thing, right?
Okay.
Typically, when I talk to people that have investments in retirement plans, I find that they're focusing on the wrong thing. There's a myth out there that suggests that up is good and down is bad. And I believe in this industry, have been given the opportunity, especially in the 401k/qualified plan arena, we've been given the opportunity to teach America how to invest. And I'm going to say this right here and now, and I probably will say it again because I know I've said it in the past. We have failed the American people. We have led them astray. And these two statements prove that. And now I, Jay Thomas, I'm going to pull the Rush Limbaugh and say, I'm going to solve it all for you right now.
Wow.
My infinite wisdom, all that, however he used to say that. But the real point to this whole thing is a well-diversified portfolio with the right mix of stocks and bonds based on your particular risk tolerance. And that is the deal right there. Two things in that statement: a well-diversified portfolio. And then the second part that's super, super important is based on your risk tolerance. And so why is it that we would say that? Well, there aren't very many advisors out there, and I'm surely not one of them, that has a team that's going to be able to choose how a market is going to react. It's just too dynamic. It's just too big with all of the factors that affect a market, the market. There is no way you can predict. There just isn't. There's no way that you can consistently prove what's going to be up and what's going to be down. We've tried it. So many people have tried it. And so many folks will say that they can do it, but they can't do it for the long term if they can get it done. And if you find someone that is getting it done, you have got to look at their failures, because nobody gets there hitting the ball out of the park. And that's why there's the theory that if you take a monkey versus a financial advisor and give them a dart and have them throw it at the board to figure out which is going to hit it's going to be the bullseye for them to hit as to what's going to be going up. The monkey will be doing just as good as a financial advisor, if not better. It's just very, very random. The very fact that in order for something to go up, that would suggest that more people want to buy it than not. And for something to go down, that suggests that more people don't want to buy it, more people want to sell it than not. So based on that, what do we do? Based on that premise, if you can just allow me to have that, what do? Well, we already talked about dollar cost averaging. Big thing is having a well-diversified portfolio. There's a different scenario than the banking scenario that we can bring up. I'm sure you remember the quote unquote tech bubble, right? So I happened to be in the market on the phone during the tech bubble. And I remember that at that time, the major part of the growth in the S&P 500 was tech stocks. We're talking those big ones, the Microsofts, the Googles, the Dells, and there was a few more there. Those were the ones that were running the growth portion of the Index 500. So if you took a look at what we call the S&P growth, as it were, the index portion of that 132 stocks there, you take a look at that, then you would see that was the main engine. This is back in 2001. And then we know what happened. The downturn. Okay. And that was tough for a lot of us. And I remember being on the phone saying to people, well, we don't know what's going to happen with that, but a well-diversified portfolio would suggest that you spread your assets out. And I got a lot of pushback. I mean, a lot of pushback, because that's where the money was going. Okay. Then, as you know, the market tanked. And then I remember saying to myself, oh, this is the time to get in, because this is the buying opportunity. But if you're looking at your portfolio, you're looking at, it's down. And so then I go back to what we as financial advisors are supposed to do, and the myth that we put out there in front of people in order to make money. And that is that up is good and down is bad. And it just really depends on who you are, where you are, and where it is that you're going. So we can't just make that blanket statement. All right. So I digress. Let's get back to what do? Okay. You got to get a well-diversified portfolio. Now, what do we mean? That means we're going to spread those assets around, and we're going to spread them around as much as we can. I have a colleague who takes a look at the reports that we generate for our clients and goes immediately to where the money is invested. That is, how diversified that asset allocation really is. She goes there, and she pretty much goes there before she does anything else, because she wants to make sure that the investments are well diversified, because she knows that some part of the market's going to be up and some part's going to be down. Some's going to be out of order. Some's going to be big, even through time, just through normal market oscillations. Part of it's going to be up and part of it's going to be down, and that's not a bad thing. However, when things get out of line, you have to be ready for that. And we have these wonderful tools called rebalancing, which keep them back in line, which allow you to get back to the risk tolerance that's important for you. And it allows you to take advantage of market upturns and downturns. So this whole discussion this morning is about, since you can't figure out when it's going to happen, and we know that the market's going to go up and down and stuff is going to make it go up and down and what have you. If you don't know when that's going to happen, at least you can take advantage of it. And of course, the best way to take advantage of it is to buy low and sell high, what we always preach. And my favorite thing is rebalancing your portfolio. So that's what we want to talk about today. A well-diversified portfolio and rebalancing that portfolio on a regular basis.
Okay. And I think, the one thing about this whole banking thing, because this is not the first time banks have closed, right? And everything in this world is kind of cyclical, and there's history, right? And if you go back and look at, we kind of put all our focuses, like doing the .com craze and bubble. Everything went into that. Everything. We just hyped all of that, everything into that. Really, some closed eyes. Everybody was dumping money over there. I was working in it, and I work in the financial sectors of companies. So I see whether or not the skill sets are there, the management skill sets are there to manage those kind of monies. A lot of times they're not there. They just stars in what they do, or people place them in what they do. And in most cases, they were not equipped to manage that type of money. And I think that's kind of what's happening right now. I mean, SVB, it was all about mismanagement.
It was. And, I think you and I can have this discussion, I think, because we're colleagues and friends. But I think what you're talking about, and I hope this comes across the right way, is noise. That's the stuff that we get, right? That's the stuff that's out there that says, hey, they weren't running things right. Hey, da-da-da-da-da-da-da-da-da. If it's 3% of your portfolio, that's not such a big deal.
Right.
Which is where we, as 401k investors, we have to look at all of that stuff as noise in the channel. If I'm outside of my 401k, now, that stuff that you're talking about is an incredible insight.
It is.
Right? It's like, it's very telling. Outside of my 401k, what you're talking about is makes sense. And we have to, I would think we would want to pull the thing that Mr. Buffett has been blamed for doing. Am I going to invest in that bank? Well, let's see how they run their money. Right? If I'm going to make that decision, let's see if I'm going to put some money in there, let's see how they run the money. How do they do their job? Right? And is that something that I agree with? And what are the ramifications of that? We need to make that if we're going to make an individual sell. So, for example, I had a friend of mine that had 10 stocks, I want to say, 10 stocks that he bought. And he considered himself well diversified. But And if that's their deal, then he's a great guy. If that's your deal, then it behooves you to look at where that money is going, right? To make sure you know how those folks are actually making the money. Are they doing it in a good way? And I will go so far as to say to you, that's why, back in the day, at least, I haven't seen the figures for about 10 years, but that is why back in the day, women investment clubs outformed their male counterparts 2 to 3 times, one third to 2/3 of the time, because they took their time to do the research, right? If they were buying a car, let's say they liked XYZ car, then the group would say, why do I like that car? It helps me do this. It helps me do that. It helps me do this. I like that car. When the car made this improvement, sales went up. When the car did this, nobody gave a darn. What are they doing now? How do we do that? They did their research on the car. They used the car, and they understood what was going to make that car sell. Right? They understood that if somebody put blue lights on the place with the red lights, that nobody gave a darn. But they also understood that if they put an extra safety feature on, people were going to go, yeah, we need that. Let's get that car, right? They understood that kind of thing. Their male counterparts were looking at the numbers, and they're going, well, the profit to, or the PN, what is it? The profit to stock ratio is up, or the PE value is up, the price to book is wherever. Let's do that. No emotional attachment. Right. So now, where did these female investors fall down? Where did they lose to the male counterparts? Well, in most things, they didn't take enough risk.
Yeah.
They could have taken some more risk. But if you're looking at 2/3 of the time versus 1/3, that ain't bad.
Right, exactly.
I mean, go with the deal. That's not such a bad way to go. We can talk more about that later. But getting back to this thing that is inside your retirement plan, how do you know you have a well-diversified portfolio? How do you know, and why should you care? And I think if we take the second part of that, the reason we should care is because we don't have this. We don't have a big team of investors.
Right.
We don't have time to do that. And our 401k is set up for those of us who are regular people to not have to take advantage of, I don't want to use that word insider, but let's take advanced knowledge of particular products to make a decision. We don't have time. We're not set up for it. It's not going to work for us. What do? We buy a big basket. Most mutual funds have between 50 and 150 investments inside them. That's spreading your risk out, right? We want to invest in many industries as possible, spreading the risk out.
Right.
So that's how we win. That's why a well-diversified portfolio is so important for times like this. So what happened back in the day when I was on the phone and people were saying, you should have a fund that's specifically in technology. I'll give you this. I was working for a very large company, and we got beat up. I personally got beat up on the phone quite a bit by people saying, you should change this fund to a technology fund. 2020, 2019. Change it to a technology fund. That's where the money is. We like the way these guys manage. We want them to change to that technology fund so we can make money. We're losing out. 2001 happened. Boom. Fund loses tons of money. So I think taking a look at strategic investing versus, let's call it day-by-day investing, tactical investing. Right? You as the investor have to make the decision what is going to work for you. And the 401k plan, the qualified plan, be that a 403b, 457, defined benefit, These are set up as strategic investments, long term. You're going to be in the market for a long time, but more importantly, not only going to be in the market for a long time, but you're in the market for a long time, taking advantage of market upturns and downturns.
Right.
And the best way to do that is a well diversified portfolio.
Yeah. But I think it's what what we've been saying over and over again is, one, you have to have that. You just can't let your company manage your retirement plan and you be hands off. You just can't. And not in this very volatile time that we live in. It's just too much stuff going on. This is not 1950. Things change too rapidly now, and we have way too much invested into our retirements now, and the economy is, I mean, the cost of living is too high.
You think
have
so?
to be. I think so. I think our way of life is a lot more volatile than it used to be, right? We do more, we're connected more, our cost of life is more, right?
Hmm?
we
Very
have
much.
we have bigger visions than we did. We don't just go to work and come home and sit and watch television, right?
Granted.
We go on vacations. We're invested in it costs more for our children to go to school.
Yeah.
So our money matters more.
Okay.
It really does
I mean, I'm
matter more.
agreeing with you, but
Yeah.
I don't see how that is. So talk to me about why that is more
Before than now.
prescient than before.
Well,
Because I'm
I
still doing
think
the fundamentals.
because I think I mean, I look at when my when my grandparents were retiring, even when my mom was retiring. I remember when a bunch of her friends were retiring, you know, their needs were pretty simple. And that was like 30 years ago, 30, 40
Right?
years ago. Their
Mhm.
needs were very simple. But now I look at my friends today, their needs are bigger. I mean, most of them are starting second acts, new job, bigger, their own businesses.
Sure.
So
Yeah.
and their health is different. You know, they're
Mhm.
more active, they're living longer.
Yeah.
But you know, when my grandparents were looking at retirement, they were like, okay, maybe I got another 10 years. So
Yeah.
no biggie, right?
Yeah.
Now people, when they look at retirement, hey, I got another 30, 40 years to go.
Yeah.
I got to make my money last 30, 40 years because I'm not
That's
checking out of here in 5,
yeah.
10 years.
Yeah. 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 Well said. Well said. And so, and then
Right?
we get those, and we rely upon the resilience of the American people, right? So
Yeah.
you've got another 30, 40 years possibly, and quite possibly. Um, how much do you want to depend on the system to feed you your needs? Are you going to be rallying for the system to feed more of your needs?
Right.
Or do you have to start that second act
Yeah.
or third act, right? So
Right.
that's where we are. And I have to say that that's why the concepts that you and I talk about are so important. That's why
Mhm.
that concept of don't be that guy is so important
Mhm.
because of what you said, the intensity of the delta with regard to where we were as a society and our needs now is so big. And I would say the intensity of that is so dramatic. It's become
Mhm.
so dramatic. Not only is there a big difference, not only am I going on vacation and paying for my kids' college and doing, not only is that delta big, but the
Mhm.
intensity is there, right?
Mhm.
The emotional connection to that delta is also big. And therefore, I would say that you need to start early
Mhm.
and you got to take more risk. You just have to. There's no other way you're going to keep up because unfortunately, the wages haven't gone up as much as the intensity or the
Mhm.
delta.
No, 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 no.
And I would love to say, okay, here's the philosophy. This is how you, number one, keep up with inflation. Number two, provide enough for your family to take care of itself. And number three, make sure that while you're doing that, you too have a good life. And here's the way to get it done. And I wish I could do that as a financial advisor. And if you can find a financial advisor that's going to tell you something different than what I'm saying, I think that would be really cool to talk to them. I can only say start early. If you're a regular person, I mean, now some of us have the advantage of having a trust fund, or we got out a job and we got one of those jobs that, man, we started kicking behind and buying rent or places where we could rent. We got real estate and we got this little thing and that little thing. And of course, we're getting tax advantages and all that kind of stuff. That ain't everybody.
Right, exactly.
Us regular people are living on our paychecks, and we are trying to make it happen. And, God bless you if you have the ability to be able to have less month than money.
God,
that's
the
not
joy.
That's
the
not
joy.
Actually, you got some decisions to make.
Right.
And in that decisions, you got to take care of today and tomorrow. And for many of us, not only you need to take care of yesterday too. All right. So let's just call a spade a spade. There it is. All right. So what do we do? Well, we put a little bit less in that 401k plan because we will deal with that when we get there. And I'm saying that's the exact opposite. I'm saying that's just like most people do when it comes to choosing their investments. They focus on the wrong thing.
Yeah.
The way to make this win, and even more so now, is take that questionnaire, make sure you've got the right risk tolerance, and get a well-diversified portfolio. So because you can't choose which one's going to go and which one is going to fall and what time it's going to happen, just consider they're all going to go down and they're all going to go up. They're just going to do it at different times. And at those times when they'll do it all at the same time, we couldn't do nothing about that. No way. Everything is on sale.
Yeah.
It's funny to me, and you can tell me what you think about this, but it's funny to me that the U.S. is populated with some of the most optimistic people that are in the world. We are so optimistic. We're so optimistic that we even think that when the sun is out, it's good, and when the rain comes, it's bad. I mean, we are extremely optimistic here. And we're very, in some ways, I don't want to use the word simple, but we're very predictable. We see the market going up, we figure it's going to keep going that way. We see the market's going down, we figure it's going to keep going that way. And nothing could be further from the truth. So how do we protect ourselves? We get a well-diversified portfolio. That's the whole deal.
Yeah. Yeah. Sometimes I think I guess the rest of the world can be a little bit much more not as optimistic as we are here in America. Sometimes we're like, okay, can we just pull our head up out the darn hole and take the rose-colored glasses off and see the real world? Case in point, right? They moved up our age for retirement in America. It just so nonchalantly happened, right? They made the decision. Somebody tell you, oh, by the way, it's now 67 that your retirement, it went from 65 to 67. No big deal, right? Mm-hmm. Then a month later, parents are like ready to burn the place down. Like, what the hell?
Right. You don't want some 62-year-old man doing XYZ.
They are burning the place down. Yeah, completely different reaction. Ours is somebody had to tell you, like, oh, did you hear, by the way, in conversation at dinner, on the way to dinner, they changed. When did that happen?
It's an excellent point.
Right? Paris is like, did you see on the news? Paris is burning France down.
Yeah, 63-year-olds are burning. It's a very interesting point. I think you're making a very good point. Where we seem to be, maybe this isn't germane to the topic, but we seem to be hanging on to our youth. It doesn't matter if we're 65, 75, 85. We are trying to be as young as possible.
Yeah.
Which would suggest maybe it suggests, what do you think, that we're saying we got time to invest because we're not stopping the work thing at 65 like we're quote unquote supposed to, and retiring and then sitting back and coming out of the workforce and doing nothing. Oh no. Some of us are starting that second act so that we can even make more money. Or that we can actually have that income and supplement that. We're trying to live in that youthful state, and I don't think that's such a bad idea when you get right down to it. I really don't, especially since we're living into our 90s. But I don't think it's a bad idea because that allows us to have that wisdom in the workforce.
Yeah.
Whereas in some places where you're supposed to retire at 62. You have to get that wisdom from a different spot, which is okay, but it's not necessarily present in the workforce. I think better paid people than I may decide what's better based on outcomes for the society. Do you retire them at 62 and make sure that everybody gets out of the office, gets out of that work rat race by 64, so that they can pass on that wisdom in a loving and a kind and whatever kind of way? Or do you keep them in the workforce and, work them till they drop? What's the what's better for the society?
I was talking to my girlfriend this weekend, and her boss is retiring. I mean, it was so funny because he made a very good decision when he started his business. He was an engineer at one of the, at that time, Lockheed, Rockwell, whatever one was around at the time. He said he had a really cushiony job, made good money, didn't really have to leave, but just saw life a little bit differently. He's an Asian guy whose family immigrated here from China. But he said his father was the type of entrepreneur, was a feast or famine type of guy. And so he said we could be sitting on top of the Hollywood Hills one day, and the next day we living in the streets. So he just wanted to make sure that that wasn't the kind of life he wanted to live. But so he went to school. Father obviously educated him very well. Went to school, but he was saying when he was as an engineer, he's like, he could have stayed at his cushiony job and never thought anything, had great retirement and what have you, but he wanted something of his own. But he didn't want to start it from scratch. He did really well, bought a company, but he looked around to find, kind of like a Warren Buffett mentality. Okay, what does the world need and that I can provide? And everybody needs. And so he went into the fiberglass kind of business. He bought a business that was already established, had a small number of employees, and he built it out to 50 employees. And he actually created an ESOP. So he in addition to that, he bought other businesses along the way. He's retiring pretty damn well. Okay. But also didn't and created an ESOP, so his employees are also going to be taken care of as well, because he wanted to make sure that everyone had the kind of, American dream, and most of everyone at the company are minorities. Majority of everyone at his company is a minority, so they all have a buy-in to the company. So he's walking away from the company with his retirement well intact. But it was the way she was saying it. He said, yeah, I could have been like my dad, but or I could have stayed at that company and just retired with whatever I could have retired at. He says, but I thought there was so much more. And it just gave me the ground. It gave me the leverage that I needed to be able to make sure there was so much more. And then even then I could have started a company that would have just been for me. Sure. But I thought, no, let me choose a retirement plan that was for me and would benefit my employees. And and they would come out of it just as like myself. And so he did. And I thought, well, wow, what a great mentality to have. And so he retired. He has to delay it a little bit because I think it's some sort of ruling. He couldn't I think he has to delay it to August until he could put out all of his money.
Okay.
And so he's going to be completely retired in August, and doing pretty well, I guess, going on to whatever the next act of his, because he's young.
It is kind of great where you can see those things happen. Or number one, it's wonderful when you can take advantage and you can do those things. But I've learned that not everyone has that entrepreneurial spirit.
Yeah, and that's true.
If you don't have that, kicking yourself because you don't is no way to live either. But if you have enough people who are entrepreneurs who decide, a rising tide raises all boats. So I'm going to provide for the people that take care of me and help make me who I am. I'm going to provide for them, which is, the force behind the ESOP, depending on how you look at it. I mean, some of our other friends may say that's just, wealth distribution at the government level, taking money from wealthy people and giving it to poor people. But if we look at it, and I think it does better for our society if we look at it as an opportunity to be a little bit kinder and say this is a way for wealthy folks to raise that tide, to be a part of raising that tide. And I think I'll just go out and say it right now. I think that that mentality is what, it's not where America came from. It's not how America got here. But it is an opportunity that we have. And it does make the expectation or give us the opportunity to create and to create in a different way. Lots of folks don't think that's the way to go. I mean, there are lots of folks that say, hey, I got mine, you get yours. If we all get ours, then everything's going to be great. And I think we see the ramifications of that in a lot of things.
Yeah.
And I think that, and I'm trying to sidestep so many issues here.
Right.
I think that no matter what path you choose, be that something as spiritual as yoga to something as secular as fiber optics.
Right.
You can still have that mentality of rising tide, or I got mine, you get yours. We all take care of ourselves. It's an interesting debate, I think.
Okay. Yeah, it is. It is. And we're living in very interesting times, but I do think people, as we have said time and time on this show, is that you do have to take a very vested interest in your retirement and really seek the advice and do the research for yourselves, right? And so that second scenario is not a bad scenario. Wherever your money is going to be, you do need to do your research.
Not only wherever, but whoever.
And whoever, right? Whoever, so just don't blindly just allow it to be wherever it's going to be, and make an assumption that the powers that be happen to be all knowing, because that probably is not the case.
We most certainly know it's not, and we see that in our own families, right?
Yeah,
this is the person that's going to take care of things. Number one, they got their own needs to take care of. Number two, they would love to if they didn't have their own needs to take care of.
Right.
But number three, where do they go? What do they do? It just doesn't, like, you just don't wake up. You don't wake up learning how to take care of a kid. You don't wake up learning how to take care of your parents. It just doesn't like fall like manna from heaven. You know, you need to get that information. And Lord help them, just give them some help. You know, give them a little help to help them help you. Give them a little help, right?
Right, exactly.
Surprise them with it.
Imagine that.
I mean, we just kind of think about it that way, you know. As selfish as that is, but you know, it's very, I think it's very helpful. I mean, God bless your mom for taking care of herself so that you could proceed down that road with a little bit of guidance and some cash to make things happen well, right? That made your life dramatically easier. My cousin was telling me about someone in our family where that wasn't the case. And oh my goodness, people are scraping and scrapping and trying to figure out how to take care of these folks in a horribly emotional time, you know.
Yes.
In a time where you want to be mourning, but you gotta figure out how you're gonna pay that funeral home. That's
right.
Rough.
Yeah, and you just can't leave that up to, you know, to chance and assuming that it's going to take care of itself. It's not. You have to pre-plan for that sort of stuff. And so retirement is part of that pre-planning, because it's going to happen. You know, those are things like, you know, that's actually more imminent than birth. Not everybody has children, but everybody gonna die. I do know that. You may not get to come here, but if you are here, you are gonna leave here. I've been told that the most imminent things on this earth is paying taxes and dying.
Those will happen. Yeah. Well,
they are
on that note,
yes,
I think we should just leave it right there. Okay. And how about if I read your bio and give you the last word?
All righty.
Okay, here we go. Woo! So thank you, Crystal Mitchell, for joining me. Everyone, I want to tell you just who, or partly of who this lady is. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions. She's the co-director of Recycling Black Dollars. She's a co-host of that other weekly internet show, The Business Zone with Crystal and Gilbert, weekly radio show. She's an instructor at Mount San Antonio Community College. She's a certified network for teaching entrepreneurship instructor and a QuickBooks Pro Advisor financial strategist. Crystal Mitchell, thanks for joining me for this hour. Take us out.
All righty. So, guys, it's just a wonderful for this conversation, and these conversations are important because in a world where everything is going on all the time, just stopping and taking time out to hear someone like Javon, who's a retirement plan advisor. You don't really just run across those people in your everyday life. You might run across them at a party, but generally they're not there to have this conversation. So here we are, just having this conversation on the patio about retirement, because you have to be prepared. We are always thrilled to be here every Monday to have these conversations on the patio to talk to you about planning and being prepared for retirement, so you can enjoy that retirement, because it requires research, planning, and some thought. And so we will see you again next Monday at the same time, 1:00.
Next
Pacific Standard Time. Bye-bye, guys.
Bye-bye, everybody.